If I could only invest in 3 mutual funds for the rest of my life, these are the ones that I would pick. And this video isn't just about fund names, which I will share. It's about teaching you the art of building a rock solid mutual fund portfolio. It's one of the most important skills when you're investing your money. So I'll take you through the exact logic behind my picks, so you not only know what to invest in, but also why, which is much more important. That way you will learn the key principles of creating a balanced and effective portfolio for yourself. Because here's the thing, I have noticed way too many people obsess over one mutual fund in their portfolio and how it performs, whether it's good or bad. But the reality is that individual fund performance isn't what makes or breaks your wealth. It's the overall performance of your portfolio that really matters. So as I go along in this video, remember to think about your investments from a portfolio perspective. Hello everyone, I'm Udayanath De and I've been licensed in Indian financial services since 2015, and so far I have helped over 1,500 families take better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. So let's get started. Firstly, it's also important to know that this portfolio is meant for your long-term goals only. So that is goals that are at least 7 years away. And it is also an aggressive portfolio, so keep that in mind. Now, when it comes to building a lifelong portfolio, I'm focusing on two key principles. First is diversification in stock size. So I would want large cap, mid cap and small cap stocks as I build this portfolio. And the second is a variety in investing style. So in this portfolio, I would want growth style investing, value style investing and momentum style investing. Because if you pick 3 funds that all invest in, say, large cap stocks, you're not really diversifying. You're just overlapping your investments, which just defeats the purpose of having multiple funds. So to avoid that, let's structure this portfolio strategically. Here's a simple grid to guide us and we'll fill it as we go along. The goal is to leverage the unique strengths of each fund while minimizing overlap. So here's what my 3 mutual fund lifelong portfolio would look like. In it, my 3 funds are, first up, the Parag Parikh Flexi Cap, where 50% of my money would be invested. The second fund is the Nifty Midcap 150 Momentum 50 Index Fund that would get 30% of the money. And finally, the third fund is a small cap fund, the Nifty Small Cap 250 Momentum Quality 100 Index, and that will get the remaining 20% of my money. Before I get into the logic of why I have picked these, let's quickly go through the performance of this portfolio. So we'll compare that against the Nifty 50 and Nifty 500. 1 lakh invested in the Nifty 50 would have grown to about 3.52 lakhs in 10 years. That's an annual return of about 13.5%. In the Nifty 500, which invests across large, mid and small cap stocks, a 1 lakh rupee investment would have grown to 3.79 lakhs. That's an annual return of 14.3% across a 10-year period. But this 3-fund portfolio, 1 lakh invested in it would have grown to 6.19 lakhs. And that's an annual return of 20.08%. This outperformance is very evident, and let me show you how consistent the outperformance is. So here you go, I've plotted the Nifty 500, Nifty 50 and this mix, which is the portfolio that we have here, across the last 10 years. So there you go, starting from 27th May 2013 to 23rd Jan 2025. You will see this line of our mixed portfolio at almost every instance, in fact, definitely at every instance has performed better than both the Nifty 50 and the Nifty 500. Even during the COVID crash, you will see that the 5-year return of this particular portfolio was positive, whereas with the Nifty 50 and Nifty 500, it was marginally negative on a 5-year rolling basis. Then we'll go through the standard deviation as well. This portfolio has a standard deviation of 6.16. compared to 3.62 and 4.38 of the Nifty 50 and Nifty 500. That kind of indicates that it is a little more volatile than the other two, but the performance has been spectacular. So personally speaking, I'm okay with taking on that slightly higher volatility. What is even more crazier is that over any 5-year period, how many times has this portfolio returned over 20% annual returns, right? That is what this particular section of the table indicates. And in this mix that we have, right, in this 3-fund lifelong portfolio, that has been over 50% of the time, which is staggering, right? Not only are the median annual rolling returns about 20%, but Even from a consistency level, the returns have been about 20% half the time, whereas it is a very low number for the Nifty 500 and the Nifty 50. I'll get to the logic behind why I have selected these funds and even the specific weightage in the portfolio. But if you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. Now let's get back to the video. Now through this 3-fund portfolio, a large part of my money gets invested in large cap stocks, which I want as the foundation of my portfolio, and that's why they have the largest allocation. But then I also get mid cap and small cap stocks. It also has, by the way, a diversification at a country level, which I'll explain in just a bit. And it also helps me get access to different investing styles. I'll take you through each pick to help you understand the logic even better. Firstly, let's go through why I have picked the Parag Parikh Flexi Cap. There are 3 main reasons and all are interconnected. First up, it is a Flexi Cap fund. Now, generally when you're looking at funds, look at the name and it will tell us which category it belongs to. Now in Flexi Cap funds, the fund manager has the freedom to invest across large, mid and small cap stocks. There are no rules that it should have a minimum amount in a certain category, making it a very flexible choice, and that's how it gets its name. Historically, and even right now, despite being a Flexi Cap fund, the Parag Parikh Flexi Cap has been a large cap heavy fund. Here I am on ET Money to show you exactly how the allocation is at the moment as of the end of December. So if you notice, out of the 100 rupees that the Parag Parikh Flexi Cap invests, about 78% is in equity, whereas the remaining is spread across bonds or even cash. Out of the equity part, you will see over 90% is invested in large caps. From an overall portfolio perspective, 72% is invested in large caps and a very minor amount in mid and small caps. So for all practical purposes, the Parag Parikh Flexi Cap is a large cap mutual fund, though it has the liberty to tweak around wherever it wants to invest depending on what the fund managers think. And that's why it is the large cap play in my portfolio. I would have 50% of my money in it as I want the solid large cap base. Now, while mid and small caps offer potentially higher returns, they are also more volatile. That is, they tend to move up and down a lot more than large caps. So I would want to limit their exposure to a certain extent, and I would want large caps to be a major part of my portfolio. At the same time, the second reason I've selected this particular fund is because it follows the classical value style of investing when the fund manager selects stocks. This approach focuses on identifying high quality stocks that are potentially trading at prices that are below potentially their true worth. Why does this matter? Because it complements the growth and momentum styles that I have in the other 2 funds that I've selected, and more on that as we go along. By diversifying investing styles, I'm hedging my bets and ensuring that my portfolio is prepared for a variety of market conditions. Here's a quick explainer of what value style of investing is. It's like trying to find hidden gems, undervalued companies with solid fundamentals that are expected to deliver long-term growth once the market realizes the true value of these stocks. Now, the third reason why I have picked this fund is global diversification. Again, as of December 2024, 12.82% of this fund's portfolio was invested in international stocks. It had 4 foreign stocks specifically. First is Alphabet, that is Google, then Meta, Microsoft, and Amazon. Now, such a global diversification can be very beneficial. It reduces country risk and also allows you to enjoy growth happening in different parts of the world. I'll give you a very practical example. In March 2020, after the COVID crash, the Indian stock market took till about July, August to start really going up, whereas the US stock market started rising almost right away from April onwards. Now, different conditions affect different countries, so having a part of your portfolio outside of India can be a good idea. So by investing in just one fund, you will see I get 3 benefits. First is getting large cap exposure, then having my money invested basis the value style of investing, and thirdly getting exposure to international stocks. Now one key point here to note is that while this fund has about a 12% exposure to international stocks, in my overall portfolio that will drop to about 6%, which is lower than ideal, as I would want about 10 to 15% at least. But since we are keeping the portfolio size to just 3 funds, I feel this is good enough. And also, as of January 2025, direct investment in global mutual funds from India is capped and they are not accepting any fresh money. So this makes the international exposure offered by the Parag Parikh FlexiCap quite wonderful and valuable, right? Because it's one of the few viable options to get that foreign exposure right now. Going back to our grid, this fund sits comfortably in the large cap and value investing style boxes. The second fund in my portfolio is the Nifty Midcap 150 Momentum 50 Index Fund. Currently, it's offered by Tata and Edelweiss. They have index funds that track it. And if you've been following my channel and my videos for a while, you already know that I'm a big fan of this category and for good reason. This fund in my 3-fund lifelong portfolio serves a dual purpose. It provides exposure to mid-cap stocks which offer higher growth potential, and it also follows the momentum style of investing, which is a completely different philosophy from the value-driven approach of the Parag Parikh FlexiCap. Momentum investing is built on a very straightforward yet powerful principle. A stock that is rising is likely to keep going up in the short term, while a stock that is falling is likely to continue declining in the short term. So instead of waiting for a stock price to fall and buying it at a lower cost, momentum investors buy stocks that have already started rising, betting on that trend continuing in the near term. Similarly, they exit a stock as it loses momentum. I know this might seem counterintuitive because we are often told to buy low and sell high, but momentum investing has consistently proven effective even in the Indian market. It's like riding a wave. You jump on as it's rising and hop off when it starts to crest. Here's a quick comparison of how the midcap momentum index is done versus the regular midcap index. So if you notice, once again, at almost every instance, except for some very minor periods in the early 2010s, the midcap momentum index has performed better than a normal midcap index by a large amount. Let's look at actual numbers. Since April 2005, the midcap momentum index has delivered, wait for it, 23.6% annual returns on a 5-year rolling basis, compared to 15.3% for the normal midcap index. Which means a 1 lakh investment in the momentum index in 10 years at that rate would have grown to 8.32 lakhs. While in a normal midcap index, where the returns by no means were low, it would have become 4.15 lakhs. Now let's go through how much more volatile the midcap momentum index is. The standard deviation is 8.68 compared to 7.17 for the midcap index. So it's not that high. Especially if you again consider the significant outperformance of the momentum index, I would take that very minor increase in standard deviation of volatility every single day. Having said all of that, it's important to be aware that momentum investing can be like a roller coaster. It can be more volatile than other strategies. So it's not for the faint-hearted. But for those willing to embrace the ups and downs, it can be a powerful way to boost your returns. And that's exactly why I've included this midcap index in my lifetime 3-fund portfolio. In our grid, it sits in the midcap box and the momentum investing style box. Now let's move to the third and the final fund in this portfolio. It is a small cap fund and has 20% money allocated to it. It's called the Nifty Small Cap 250 Momentum Quality 100 Index. Right now, Mirae Asset is the only AMC that has an index fund that tracks it. It's a relatively new index fund, but at the same time, I'll show you data as to how, when you backtest that data, and this is verified by the National Stock Exchange, how that would perform against the regular small cap index. And here's why I have chosen this fund. Firstly, it gives me small cap exposure, which I want, right? Because I already have covered large caps and mid caps. Secondly, it combines the momentum and the quality style of investing. This index fund selects 100 small cap stocks from a universe of 250 small cap stocks. And it picks these 100 based on both the momentum and quality scores that it measures. Quality here is calculated by looking at the return on equity, financial leverage, and earnings growth variability. This combination delivers a powerful strategy, momentum for capturing short-term trends and quality for ensuring the underlying companies are fundamentally strong. This combination of momentum and quality has performed splendidly well compared to the normal small cap index, and let's check it out. You'll first up see that again, almost throughout the entire almost 20 years now, this data is from April 2005, you'll see that the momentum quality small cap index has consistently done better than the regular small cap index. You will see that in the past, I would say 5 to 4 months, you will see that the two have sort of converged in terms of performance. So once again here you will see, if you look at the latest data, right, the momentum quality small cap index is 23.33, whereas the normal small cap is 26.55. So hardly anything there, correct? At the same time, what is even more crazy is that over a 5-year period, the small cap index, the regular one, has done 12.8% annual return on a 5-year rolling basis. This is the median rolling return. Whereas the momentum quality 100 small cap index has done 21.9%. Can you believe that? Right? 21.9%, almost 10% higher, over 9% higher. And at the same time, the standard deviation is 8.63 for the regular small cap index, and it's 8.69. So it's almost the same, right? You can call it the same. What is even more crazier is the minimum return, right? So over any 5-year period since April 2005, what is the lowest return that you would have gotten? And here you see the small cap index is minus 6%, whereas the momentum quality index is 0.7%. So that essentially means that over any 5-year period in the last 19 or almost 20 years, it has never given negative return. And you can see that in the chart as well, right? You see the effect of the 2008 crash. The regular small cap index was negative, whereas the momentum index was even positive then. It was also positive during the COVID crash, right? The small cap index was minus 5%, whereas the momentum quality index was plus 1 or so percent. Having said that, you can also consider some actively managed small cap funds that are offered by SBI, Nippon India and Quant, because their performance is very, very similar to the momentum quality small cap index. So if you want an actively managed fund, you can essentially swap out this small cap index fund that we have with either the SBI or the Nippon India small cap fund. But we want to know the style as well, right? So both the SBI and Nippon small cap funds follow a blend of the growth and value style of investing, which is again different compared to our previous two funds. And if you're confused about which style of investing a particular fund follows, then you can simply take advantage of artificial intelligence. So I'll simply go to perplexity.ai and ask a very straightforward question. You are my investment researcher. I'm giving it a very clear command. Tell me which style of investing is followed by the SBI small cap and the Nippon India small cap fund. So let me go for the search and then quickly tell me the investing styles that it follows, right? So there you go. The SBI small cap predominantly follows a blend of growth and value investing. We get our answer right away. And once again, the Nippon India small cap predominantly adopts a growth-oriented style of investing. If you want to know how you can again just use AI to get better at investing like this, we touch upon it in the program that I have, the complete guide to mutual fund investing that I told you about. But if you're also looking to just get better at using various AI tools, not just with your investing life, but also at your work, right? As an employee, you want to do better work, you want to do more efficient work. For all of that, there are various AI tools available. I'm thinking of hosting, if I get a good response from all of you, a 2-day workshop where from morning till evening, I take you through various use cases and share everything that I know about applying AI to different aspects of your life. It's something that I'm learning right now at Oxford as well. It's something that we are also trying to implement very specifically in our workflows. So if you're up for this, go to the link in the description and get on the wait list for this program, and we'll reach out to you soon. I'll also every now and then send you other interesting stuff happening in the world of AI, tools that I am using, that I am learning about as well. So if you're up for it, sign up. Now, if you're using AI tools to actually take investing decisions, it's always best to cross-verify the answer you get from any tool if you're basing a decision on it. It's almost right every single time, but every now and then AI hallucinates. So we want to always verify the information that the AI tool gives us. Now, this third fund that I'm talking about, the small cap quality momentum index fund, fits within the small cap plus momentum and quality styles of investing. And this is how our portfolio now, our lifelong portfolio, looks like at the end of it all. Now, if you look at the standard deviation, the portfolio has almost a 70% more standard deviation than the good old Nifty and about a 40% higher standard deviation than the Nifty 500. But because of this crazy outperformance, right? Anything about 2 or 3% is a very high outperformance. Here we have an almost 6.5% outperformance compared to the Nifty 50, 5.5% above the Nifty 500. So it's extremely high. So personally speaking, I'm totally okay with taking on higher risk to get this kind of a return. But that's the thing. I am okay with it. You may not be. So it's important to understand your own risk tolerance and then invest money accordingly. So if that is something that you're not okay with, you can have potentially lower money allocated to mid and small caps. So perhaps you'll have about 70% of money allocated to the Parag Parikh Flexi Cap, 20% to mid caps and 10% to small caps. You can tweak around with these changes until you get to a point where you're comfortable. It all comes down to what you are okay with. And finally, should you rebalance your portfolio? That's a very popular question, right? Now in this portfolio with no rebalancing, the 5-year median rolling return is 20.08% and the standard deviation is 6.16. If you rebalance every year, the return is 20.07, standard deviation is 6.17. If you rebalance every 3 years, the return drops to 20.05% with a standard deviation of 6.11, while if you rebalance every 5 years, the return is 19.87 with a standard deviation of 6.3. At the same time, these numbers here do not include other charges that you may incur with regards to brokerage or taxes. So I personally feel that rebalancing as a strategy to get higher returns with this particular portfolio may not be a good idea. But at times, we just feel better mentally if we book some profit. So if that is you, if that is what makes you comfortable, then you can go ahead and rebalance, right? Because when it comes to investing, there is no one right strategy. The right strategy is what helps you stay invested, is what helps you focus on your long-term goals, and is what helps you stay patient. So with rebalancing, I kind of leave that up to the person I'm talking to, whether they should or not. I personally am okay with letting it ride. Now tell me in the comments if you also want me to construct another mutual fund portfolio also with 3 funds, but perhaps one that is more stable and safer than the one that I shared today. And if you enjoyed this video, then check this one out, where I talk about a systematic withdrawal plan or SWPs and how you can use it to generate regular income from your mutual funds. And I'll see you in the next one.